After a rocky 2024, CN Rail might be turning a corner. Our next guest upgraded the rail stock from a hold to a buy, and he's the fourth analyst to do so recently. For more on this, we're joined by Benjamin Nolan, Managing Director of Research for Stifel. Hi there, Benjamin. How are you?
Well, I'm doing well. How are you, Mark?
Doing great, thank you. So CN was the worst performing among the rails last year, and you say a lot of that had to do with external factors like labor issues. What were some of the other external factors that made for such a poor 24?
Yeah, well, probably the biggest is currency, certainly relative to the U.S. rails. The move in the Canadian dollar hasn't done any favors for either of the two Canadian rails. The other big one was you had just the fires in the West, the labor issues. It seemed like it was just one thing after the other that were not helpful at all to CN in particular, but really to either of the two Canadians.
So let's look ahead now. You think that where CN Rail is trading now is an attractive entry point, and you like the potential for the operating ratio, the percentage of expenses, that key ratio for expenses to revenue, the key ratio for rails. Stock up 1.5%. So give us sort of your overview as to why this is a good entry point.
Yeah, well, I mean, the biggest component there is valuation. Shares are trading at about 18 times. It hasn't been at that level since the heart of COVID. But beyond that, I think we're now in a place where some of the labor issues are behind them. There's always potential for disruptions, but from where we stand now, it doesn't feel like it's quite as bad as it could be. The other thing that I think has been weighing on the stock certainly is tariffs, or the risk of tariffs. As we saw in the last presidential election, or the last Trump election, that was a concern particularly for the Canadian rails and Kansas City Southern at the time, which is a big Mexico business, that weighed on the stocks. As it turns out, in the long run, it didn't really have as big an impact as people thought on volumes or pricing. And so it feels like this is a similar scenario where there's a little bit of fear, and you're up against pretty easy comps relative to last year, and the valuation's at a point where it just doesn't get this low very often. So particularly against a broader index of industrials that have run pretty well, I think it is a lower risk area within the industrial world to play here.
Now, still with the tariffs, you've said that any tariffs against Mexico, Canada, China, that could hurt the rails. But are you also saying that a lot of this is posturing and rhetoric, and when the dust settles, the CN can sort of power through?
Yeah, well, it's hard to handicap what President-elect Trump is going to do. But again, if history is any indicator here, some of it is posturing. And I think that's especially true. Our view internally is that that's especially true as it relates to Canada and Mexico, maybe a little bit less so on China. And so it's effectively a bargaining tool, a negotiating tactic. And we expect there will be some, but it's unlikely to be so onerous that it causes substantial inflation in the United States. And as a function of that, we're not expecting to see big changes in rail movements. But again, I think the stock is already being priced as though, at least that's a threat.
Now, Benjamin, in terms of some headwinds and maybe some risks for CN and rails in general, you're talking about a quiet industrial landscape right now, and the fact that these rails are quite tied to volatile trucking. So could you elaborate on that?
Yeah, absolutely. Well, there's sort of two topics there. The first is, the majority of what most of the rails do, and this is particularly true of the Canadians, are industrial focused. It's the movement of commodities for all sorts of things, whether it's grains or cements or aggregates or potash or whatever. And, you know, as the economy grows, so those grow. And so a good industrial economy is good for railroads. The other part of that equation is a little bit more, the trucking part of it is a little bit more related to what consumer demand is. And trucking has been weak. And so this is the containerized or intermodal freight for the railroads. In a weak trucking environment, there's no incentive for shippers to want to shift from one mode to the other in order to take advantage of better pricing. And so in a low price environment for trucking, nobody's moving to rail, nor is it very easy for the rails to be able to get better pricing. As the trucking market comes out of its cyclical downturn, which this is the longest cyclical downturn in trucking we've had in a long time, you should get a little bit better pricing power. There might be a little bit more room for volume growth. So again, in that respect, it sort of feels like we're close to a bottom here.
And lastly here, Benjamin, you're cautious for the rails generally in 2025. You've been sort of highlighting and detailing some of it, but could you wrap it up for us here as to why you're a little cautious and you don't really expect tremendous growth?
Yeah, well, and you know, we're looking for low single-digit revenue growth, generally across low to mid single-digit revenue growth across the board. CN is a little bit on the higher end of that, but still not anything exceptional. I think that what that doesn't take into account is if there is a substantial impact from tariffs, which could have an impact. But again, I would say relative to many other facets of the economy, these are, you know, duopolies. They'll be just fine. But, you know, we think the trucking recovery will be gradual but happening. We think an industrial improvement might be gradual but happening. So rather than being cautious, I would say we just don't think that this is going to necessarily be a V-shaped recovery. Although, again, I think the underperformance of the rails and CN in particular is a good entry point for a gradual recovery.